The most expensive stock you will ever own is the cheap one that keeps getting cheaper. You buy it at $10, convinced it is a bargain because it once traded at $50. When it falls to $5, you tell yourself the value is now undeniable and you buy more, averaging your cost. When it reaches $1, you have lost nearly everything, clinging to the hope that a stock so cheap cannot possibly go lower. It can. It can go to zero. You have been taught to hunt for bargains, to find value where others see despair. This instinct will lead you to financial ruin. The lessons I am about to impart are not theories. They are the scars from my own battles, detailed in my biography. Reminiscences of a stock operator. Do not simply read it, study it. The link in the description is your map to avoid the traps I fell into. Consider it the tuition for an education that cost me millions to acquire. The public is forever seeking what they call value. They see a stock that has fallen from a great height and their mind calculates the potential return to its former glory. They do not ask the most important question. Why is the price low? A stock is never cheap without a very good reason. That reason is simple. There are more sellers than buyers. The smart money, the large operators who have a clear view of the business and the market, are not buying it. In fact, they have likely already sold their shares to you on its way down. The low price is not an invitation. It is a warning sign. It is the footprint of the elephant leaving the room. You are being offered the shares that the well-informed no longer want. They are distributing their burden to the hopeful, to the bargain hunters who believe they are smarter than the collective judgment of the market. I learned this lesson at a catastrophic cost with a stock called Imperial Steel. My reading of the tape, which is nothing more than the real-time record of price and volume that you now see on your computer screens, told me the stock was weak. The line of least resistance was clearly downward. I was heavily short, and the position was wonderfully profitable. Each day the tape confirmed my judgment. The stock could not rally. One day a distinguished older gentleman, a man of considerable standing and a director in that very company, approached me. He knew of my short position and, out of what he believed was kindness, advised me to cover my shares and go long. He insisted the stock was too cheap and that the insiders, his powerful friends, were about to put the stock up. He was sincere. His arguments were logical. He spoke of assets, of earnings, of the fundamental value that the market was supposedly ignoring. He was a respected figure, an insider. I was a young speculator. Against the clear, unbiased verdict of the tape, I chose to listen to a man's opinion. I allowed hope and the promise of an easy win to cloud the facts before my eyes. I covered my profitable short position and, compounding my error, I went long 100,000 shares. I abandoned the truth of the market for the opinion of one man. The stock did not go up. It hesitated for a day or two and then the selling resumed. The downward pressure was immense, relentless. It was not the action of a stock being accumulated by insiders. It was the action of a stock being liquidated. I held on, swayed by the man's assurances, until my losses were so severe I was forced to sell. It was a ruinous trade, one that set me back enormously. The lesson burned itself into my mind forever. The tape was right and the director was wrong. His insider friends were either not as powerful as he believed, or they were the ones selling the stock to hopefuls like me. A stock's price is the final arbiter. It represents the sum of all knowledge, all hope, all fear, and all capital operating in that issue at that moment. An opinion, even a well-intentioned one from a corporate director, is nothing against the weight of the market's judgment. Imperial Steel was cheap because it was weak. It was a house with a rotten foundation, and no amount of fresh paint could hide the fact that it was collapsing. The public, hearing the same rumors I heard, bought the stock all the way down, providing the very liquidity the large sellers needed to escape. You must burn this into your thinking. Stocks are not like merchandise in a store. When an item is marked down, It is usually to clear inventory of a perfectly good product. In the market, a stock marked down by 50 or 80% is almost always a defective product. Something is deeply, fundamentally wrong with the company, its industry, or the market's perception of its future. By buying it, you are not being a savvy investor. You are shopping in the damaged goods aisle, hoping to find a hidden gem among the wreckage. For every one gem you might find after years of searching, you will have filled your account with 100 pieces of junk that will drain your capital and destroy your confidence. The entire premise of buying cheap stocks is a psychological trap. It appeals to your ego. It makes you feel intelligent, as if you are seeing a truth that the rest of the market is missing. The professional speculator has no such ego. I never cared about buying cheap. I cared only about buying at the right time. My goal was not to buy at the lowest possible price, but to enter a trade at the exact moment that the line of least resistance was established in the upward direction. This moment almost always occurs not when a stock is at its lows, but as it is breaking out to new highs. Think of the difference. A cheap stock, one that has fallen from 50 to 10, is saturated with overhead supply. Every person who bought at 50, 40, 30, and 20 is now holding a loss. Many of them are not true investors. They are trapped speculators praying to get their money back. The moment the stock rallies from 10 to 12, the selling begins. The buyers from 15 are desperate to get out with a smaller loss. If it reaches 20, the buyers from 25 and 30 begin to sell, overjoyed to have escaped. The stock must fight its way through a mountain of sellers, each one creating a new layer of resistance. The upward path is a constant struggle against a tide of past mistakes. Now consider a stock making a new all-time high. Let us say it has moved from 50 to 100. At $101, there is zero overhead supply. Not a single person who owns the stock is holding a loss. There are no trapped, desperate sellers waiting to get out. Everyone is in profit. The psychology is one of strength and optimism. The line of least resistance is upward into what traders call blue sky. There is no history of failure to hold it back. This is where you find the market leaders, the powerful trends, the stocks that create fortunes. I made my great fortunes not by buying the laggards at the bottom of the list, but by identifying the generals at the head of the army, the stocks leading the charge into new high ground. This is the great paradox that the amateur cannot comprehend. A stock at a new high is often a safer speculation than a stock at a new low. The high price is a testament to its strength. It is a sign of immense demand, of powerful interests accumulating shares. The cheap stock's low price is a testament to its weakness, a sign of overwhelming supply and a universal lack of interest from those who have capital and knowledge. You are paid to be on the right side of the trend, not for the courage of buying a stock that nobody else wants. The market is not a charity. It does not reward you for attempting to rescue failing companies. Therefore, you must completely re-engineer your thinking. Banish the word cheap from your speculative vocabulary. Replace it with the words strong and weak. Is the stock acting strong, holding its gains and leading its sector? Or is it acting weak, unable to rally and making new lows? This is the only question that matters. The price level itself is irrelevant. A $500 stock that is in a clear uptrend is a better speculation than a $5 stock that is in a clear downtrend. The potential for the $500 stock to go to 1,000 is far greater than the potential for the $5 stock to ever see 10 again. Do not be fooled by fundamentals. Analysts will tell you a stock is undervalued based on its book value or its price-to-earnings ratio. This was the same logic the director of Imperial Steel used. But the market can and will ignore these metrics for years, sometimes forever. The tape knows the real story. If a company has a wonderful balance sheet but its stock continues to fall, the market is telling you something the balance sheet cannot. It is telling you that the future is not as bright as the past. It is discounting a problem that is not yet visible in the quarterly reports. The price action is the ultimate leading indicator. It is the shadow of future events cast into the present. To argue with it is to argue with the future. This leads us to the final, unbreakable law. It is the rule that separates the professional from the permanent amateur. It is the difference between speculation as a business and speculation as a form of self-destruction. The rule. Never buy a stock simply because it has had a large decline from its previous high. And never hold a stock that is not acting right, that is showing you a loss, just because you believe it is cheap. Your guide is not the price, but the behavior of the stock itself. If it is not acting as it should, there is a reason, and your job is not to discover that reason. Your job is to obey the message of the tape and protect your capital. Buy strength, not weakness. Follow the leaders, not the laggards. The market pays you for being correct, not for being a bargain hunter. A low price is often the market's clear signal of a danger you cannot yet see. Respect that signal above all other opinions, including your own.